To you, Sarah.
Yeah, hello everyone. Can you hear me?
Yes. Yeah.
Yes. Okay. Great. Thank you. Thank you so much. And also thank you for having me be able to participate online. This is a great opportunity to share some of this research and put it in perspective with what Annette just presented, but also what we heard earlier. So I'm much looking forward to the discussion if we have some remaining time. So I'll speed up a little bit if necessary. I'd like to start with a brief quote, which is on the next slide, from one of my interviews where a farmland investment broker told me land is a different asset class to play in. And why that is what I would like to explore with you in this presentation. Next slide, please. As we've seen already today, over the past few decades, all things nature have been subjected to finance's reimagining. Be it land, water, oil, wildlife, or weather, nature, it seems, is increasingly providing the basis for a whole range of new financial asset classes and new products. Investments in farmland have become especially prominent in the post-2010 so-called land rush, as part of which financial investors have started to invest in productive farmlands worldwide. Intensified by the global food price and financial crises in 2007, 8, and 10, 11, and as a response to the poor performance of quote-unquote traditional asset classes, financial institutions have come to consider farmland as an important storage of value and a profitable investment. The goal within this has been to turn farmland into a financial asset, that is to say, a liquid asset that can be flexibly bought and sold, while also systematically and reliably producing future income streams for investors. Next slide, please. Farmland investments, however, do not always go smoothly, which is the starting point of my presentation here. The specific material characteristics of land, along with its social dimensions and also moral connotations, make land investments uniquely complex, often more challenging than investments in other resources or sectors. To draw on my qualitative research on the interlinkages between finance and farmland in Australia, this presentation explores specifically contested land investments in the Australian context, their political implications, as well as local perception. Next slide, please. So what I will be presenting today is mostly empirically based on my research, which took mostly part between 2016 and 19, where I combined participant observation with qualitative interviews, specifically focused on so-called farmland investment brokers, who were working for farmland investment companies in a leading position, or sometimes had set up these companies themselves. And I also spoke with a variety of rural people, from farmers, tenants, farm managers, and neighbors of financial investors, more generally, to understand the implications of these investments on the ground. So I haven't really had a chance to go back to Australia after the pandemic, partly due to the fact that I had 2 babies, but also because my research has taken me a little bit into different directions after that. But I hope that these insights from about 5 to 10 years ago are still interesting for this symposium. Next slide, please. So before discussing a bit more detail how financial farmland investments have played out in Australia, let me start with a brief overview of the Australian context within the global land rush. Australia holds quite a particular place within the global farmland investment map, as it has been targeted by investors for its assumed stable system of politics and governance, strong interest from the Australian government in securing investments from abroad, well-developed infrastructure, proximity to Asian markets, and counter-seasonal production, advantaging farm exports to the Northern Hemisphere. The increase in agricultural investment in Australia over the past 2 decades has mostly been driven by overseas buyers. Next slide, please. Financial investors have purchased farms across different farming regions, from New South Wales to Tasmania to the Northern Territories, with investments undertaken in a variety of production such as broadacre cropping, tree plantations, cattle breeding, dairy, etc. In terms of quantification, the total amount of farmland currently owned by financial investors in Australia is quite difficult to calculate, and I never aimed at calculating that or trying to quantify it, as my research was mostly qualitative research. However, it is safe to say that financial actors have become quite important players in Australian agriculture, and this within a relatively short amount of time. Among the major actors that we've seen in the Australian context are pension funds, such as the US-based CIA-CREF, which manages investments, or which investments are managed on behalf of Westchester, which started acquiring land in Australia around 2007 and currently has around 380,000 hectares under management. Another key player is the Sydney-based Macquarie Group, which is a global investment bank and financial services provider, which currently runs 2 agricultural funds, which manage almost 5 million hectares of farmland, mostly located in Australia. And there have also been major investments from China and the Arab Gulf states, which I will discuss in more detail in just a second. So you can already see that there are the scale of investments are quite at a different level than in the Canadian example we just heard before, not to speak of the Netherlands and Scotland, I mentioned. So in addition to these really big players, there's also a variety of smaller farmland investment companies that are offering their services to a variety of different investors, also private investors, high net worth individuals, family offices. And also these farmland investment companies have been raising capital globally and sometimes have several hundreds of thousands of dollars under management, are often specialized on specific crops, areas, production styles, or investment models, often also tailored specifically to their investors. All right, so to come to the first part of my presentation here, these cases of more contested investments. Next slide, please. A key observation in terms of financial investment in Australian farmland is that investments have been very differently received depending on the sources and kinds of capital involved. The first rather controversial example that I would like to present here is the case of Hassard Australia, which was a subsidiary of the Hassard Food Company, which was established in 2008 with a capital base of $1 billion to secure food supplies for Qatar through agricultural investments on a global scale. This company was wholly owned by Qatar's sovereign wealth fund, the Qatar Investment Authority, which was created in 2005 to strengthen Qatar's economy by diversifying into new asset classes. Hassard Australia started purchasing agricultural land in Australia around 2010 and over its lifetime acquired approximately 300,000 hectares spread across the country while focusing on sheep wool and grain production. The expansion of Hassard Australia's holdings was quite rapid, and by 2011 the company was already one of Australia's top 10 sheep producers. Hassard, however, didn't stay for a long time. Only 10 years after its first acquisition, Hassard already completely divested from Australia again and sold its last farms to Macquarie's Paraway Pastoral Investment Fund. Hassard's investments, next slide please, were specifically controversial due to its association with producing for food security for Qatar. Next slide, please. Apart from the media looking skeptically, so to say, at these investments from the Gulf states, there was also a government committee that was looking into the matter at the time and finally came to the conclusion that foreign government entities should invest in Australian agricultural land and business on a commercial basis and not for food security purposes. Next slide, please. A second controversial example that I'd like to briefly present here is the example of the Kidman Company. The sale of Kidman, which is was frequently presented as an Australian icon and symbol of outback history in the Australian media, is probably the most spectacular land transaction that Australia has seen in recent decades. During its sale process, the treasurer twice blocked the sale of the company to a majority Chinese-owned consortium. The government's communication during this process signaled a clear preference by the state to maintain Australian ownership of this company. Their main argument to do this was the national interest, as expressed in the following statement of the treasurer, who said, "The size of the asset makes it difficult for any single Australian group to acquire the entire operation," around 10 million hectares. A review found that there remains significant domestic interest in Kidman. The Turnbull government welcomes foreign investment where it is consistent with our national interests. However, we must always ensure it's on our own terms. Ultimately, then, Kidman was sold to a group with 2/3 Australian and 1/3 Chinese ownership. Next slide, please. Where the Australian part was owned by Australian, very much famous and not very much liked Australian billionaire Gina Rinehart. The approval statement that accompanied the finally accepted purchase then explicitly emphasized that Kidman will remain majority Australian-owned, with the Australian-owned part of the consortium controlling the board and day-to-day operations of the business. Next slide, please. In 2016, another major deal was realized in the Australian cattle industry. The Queensland Investment Corporation purchased an 80% interest in the North Australian Pastoral Company on behalf of both Australian and British pension funds. Despite the size of the deal being comparable to Kidman and the involvement of foreign investors, this investment decision was highly welcomed. Rather, the deal was seen as setting a new benchmark in institutional investment in agriculture. This reaction is in line with a broader concerted call for the increasing engagement of the domestic capital in Australian agriculture, with superannuation funds, that's what pension funds are called in Australia, specifically being identified as the appropriate source of capital. The report published by the accounting and advisory firm BDO Australia in 2015 played a crucial role in putting this topic on the public agenda, revealing that less than 0.3% of my super assets were invested in agriculture. The report aimed to, quote unquote, get the conversation started on why superannuation funds are not investing in Australian agriculture and identify the underlying attitudes towards investment. Agricultural companies were thus challenged to design, implement, and execute careful and robust strategic plans to more successfully receive potential superannuation fund investment in the future. Next slide, please. So to come to a brief, first off, together, all these increased investment inflows in the early and mid 2010s and the controversial cases that I mentioned before specifically, all these led to a substantial revision of Australia's foreign investment regime for agricultural land. Since 2015, a new legal framework has been in place. Next slide, please. And there are two main amendments. I mean, this is hugely complicated, the entire investment framework. But to break it down in a nutshell, there are two key amendments that were part of this revision. First, it implemented a new threshold for Australian government to review for foreign land investments, now starting from $15 million as opposed to 248 before, although with quite a number of exceptions. And while it's also worth mentioning that the treatment of investors with foreign governmental ties remained more or less the same as they already required approval in all cases before and also in the new regime. Secondly, then, a register of foreign ownership of agricultural land was established, which within the debate showed very similar complications and definition issues as we just heard earlier. So it's a hugely complicated undertaking as well this new agriculture land register that was established. What is worth noting, though, as well, is that although there was much discussion about the national interest, for example, in the case of Kidman, and repeated requests to legally define what the national interest actually means, at the end, the national interest remained undefined, also within the new investment framework, which was, amongst others, justified as follows. As we can read in one of the reports, it is very difficult to determine what will happen tomorrow or what will happen in 5 years' time. Situations do change, and the treasurer, the decision maker, needs to have the flexibility to determine at a particular point in time what might be in the national interest. The point is that it is about flexibility. So keeping the national interest test flexible here, I would suggest, can be interpreted as a strategy by the government to maintain and act control over land and thereby buttress the state's role as the sovereign controller of land. Next slide, please. So to come to a brief conclusion of this first part of my presentation, I suggest here that Australia as an open space for foreign direct investment has become challenged in recent years. The renegotiation of lands investability has particularly been surrounding motives of food security and national interest, while there has been a search for alternative sources of capital, mostly from pension funds, in order to satisfy both the assumed needs for capital as well as a particular value system. Financialisation of agricultural land in Australia thus reflects the Australian moral economy surrounding land investments, while at the same time we can also observe that there is what I call a neo-nationalisation of land, a new combination of both neoliberal and new national principles, which are now coming together and merging in quite interesting, fascinating ways. Next slide, please. So,
well,
yes,
4 minutes left.
Okay. Okay, I'll speed up a bit. Farmland investments have also had quite tangible social implications on the ground and were negotiated here. So drawing on some research in various investment hotspots across rural Australia, I'd like to stress just a number of key findings. Next slide, please. So first off, we can see that people did not necessarily oppose the financial goals of the companies per se. Rather, people were hoping for investors to be good corporate citizens, or also perceive them as quite good custodians of the land. Next slide, please. Critiques or feelings of unease surrounding investments were thus rather related to other concerns. For example, people mentioned that they perceived there was a lack of care surrounding the mentality of investors and that they just didn't seem to care that much at all, but also a lack of transparency surrounding land deals specifically, where people voiced that they felt like, yeah, it brought a lot of feelings of like relying on the rumor mill, so to say, into the community. And while investors were looking for land, it just created a lot of intransparency surrounding what was going on in terms of the land market. Next slide, please. Second observation also, I think, aligns quite well with what Annette just presented. Mainly the importance of understanding rural communities as being composed of many potentially conflicting perspectives and interests. So we can definitely see farmers who are appreciating the increased interest of financial actors in farmland as underpinning the value of their estates, while others viewed them more as a threat to family farming and an exacerbation of already unequally distributed access to land resources. Some farm family entrepreneurs specifically have become quite financially attuned actors themselves. So they see the opportunities investment funds provide them as a means to increase their own farm profitability and flexibility. And so we can see new alliances between farmers and financial investors, while at the same time it's also clear that these are not an option for all farmers. Those who do not have the required knowledge or whose scale and quality of operations is not sufficient to raise the interest of financial actors, they cannot engage in this new form of agricultural funding. And we can also, or people have also been concerned about new power imbalances where they are expressing that basically under the new circumstances, they're not dealing with other companies anymore, but basically in some cases with actors who have government backing and therefore more or less unlimited capital at their disposal. Next slide, please.
1 minute.
So yeah, to briefly sum up here, the renegotiation of the financialization of farmland on the ground here, it reflects the societal debate, but also goes beyond it. Financial interests are not rejected per se, as they're very much part of the moral economy within the Australian context. But we need to look at communities from a variety of perspectives. There are quote unquote winners and losers. However, we do see an exacerbation of existing inequities, while also the speed, scale, and lack of transparency of these investments has been quite unprecedented. Next slide, please. To just wrap up, so financialization of land, I would suggest it does not occur randomly or uniformly. It's the result of societal understandings about the legitimacy of capital and principles of economic action. And it also doesn't emerge from nothing. It does not happen in any empty space. Rather, it's embedded in and unfolds through concrete spatial and temporal processes while affecting people differently. Thank you.